Right, it's 11 o'clock and we've got a fair bit to get through this morning. So before we get to Stephen, we'll kick off with some news as usual. Before I do that, just one bit of housekeeping for next week. I might repeat this at the end, but basically, I know that a lot of you still are accessing these through Zoom. Next week, you're going to have to use the YouTube channel link, I'm afraid, which is on the website. But that's because of the way that we're doing this panel. That's the only way it's going to work. So just remember that for next week, please. Anyway, so going back to news this week. 4 bits of things that we've pulled out here. Another merger, another wind up, and some buybacks from Scottish Mortgage, and a maybe rights issue from Regional REIT. So starting with the Henderson funds first, it's kind of obvious that they were going to go this way, I think. These funds are a similar size. The discounts are maybe a little bit too wide. So this one's 11.3. That's the Henderson European Focus. This one's Henderson EuroTrust. That's about 12. Really, I'd like to see those in single digits, but that's not the end of the world, obviously. Performance-wise, they're solid, and they're not top of the pops, but that's not the end of the world either. The funds that have been doing really well recently, the BlackRock, One, and Fidelity, but Focus does come rank there number 3. And I think this is all triggered probably because John Bennett's retiring. So he's been the manager of European Focus for a long time, and he's kind of synonymous with it. So I think it was a sort of good time to think about the future of these funds. So they're just going to knock them together to form one Henderson European Trust. It's a normal kind of approach to this stuff as a Section 110 scheme under the Companies Act, which we've seen many times before recently. But basically, Henderson European Focus would absorb Henderson European EuroTrust. And they've also got a lot of support for this already, so this is almost sort of guaranteed to happen. They'll pay out most of the income before this all happens, which just sort of evens the playing field a bit. But this isn't going forward going to be much of an income fund. And there's a 5% cash exit opportunity on both sides. 5% seems a bit mean, but I suppose the discount I say is not particularly wide, so maybe that's not the end of the world. So the way that works, if you're a Henderson EuroTrust shareholder, you get to choose between cash and a rollover in shares into HEFT, but the cash element is capped at 5%, and it's a 2% discount to the formula asset value, which is the asset value that takes off all of the associated expenses of doing this. Similarly, the European Focus shareholders are going to get a 5% tender at 2% discount to FAV. I'd imagine they'd both get taken up in full, but we'll see what happens. Most of the costs will be covered by Janus Henderson. So there's an inbuilt sort of cost subsidy into pricing that at 2% discount, but most of it is going to be covered by them. So that's good, really. So, I mean, there's no detriment really to shareholders from getting this done. In terms of the structure of the new fund, it's got to be co-managed by the managers of both funds, and it's their best ideas. So that'll be a mix of what they were doing before. But the basic thing is it's a large cap idea with the limit on the amount of exposure it can have to small caps. So they've got a small cap trust, so that makes sense. Fairly focused, and mostly it'll be things that they hold already. So there won't be a huge amount of turnover associated with putting that together. The way the fees work is obviously they've cut the fees at the same time, which is good. So there's a new kind of sliding scale there. And it does mean they end up with ongoing charges that are about 10 basis points lower than they would have been otherwise. So 0.7 from the new fund. I think the others were like 0.79 and 0.8 something. So ticking the box that way. Gearing just stays the same with existing long-term debt that's in HEFT. And then they will do share buybacks if they need to, and we'll wait and see what the fallout is of the tender office and things, and how many people subscribe for that, and it'll give us a good indication of how settled the register is. but there's going to be this 5-yearly conditional tender offer. So if they beat the index, they don't need to do it. But if they don't beat the index, then it'll be 25% tender at a 2% discount again. But that won't happen for a very long time. I'm imagining not until 2030, because the first measurement period ends on in September 2029. So that's all by the by. The process for doing this will all be wrapped up by June. We should get votes and stuff early in June based on documents they're going to publish in May. GCP asset-backed income next. So this discount, as we know, is quite wide. It's coming narrowed a bit, but basically because they've been hinting quite heavily they are going to wind it up. So they've announced yesterday that they are going to recommend discontinuing the fund. There'll be a vote on this in May, the same day as the AGM. And there'll be proposals that they haven't published yet as to how that's going to work in practice, that will be voted on the same day. They've got about £55 million worth of cash. I'll show you the sort of breakdown of the fund in a minute, which will help because they'll be able to pay a first distribution almost straight away. And they're going to keep the dividend going as long as that makes sense. But ideally, they want to find a buyer for the whole thing still, which is the reason why there's still takeover panel announcements going on stock. This is what the portfolio looks like. This they published this in January, so it hasn't changed much. But within that 187 is the 55 million that's now cash. So they had 32 million against some nurseries, and they had another chunk against some property investments. Both of those have now come back as cash. So you've got there, a fair chunk of the money, almost half of the fund, that's going to be able to turn into cash within a year. But the rest of it does stretch out quite a bit, with some 20 years plus. And this is why it'd be a really good idea if they could just sell these. Obviously, if they're looking to sell them, there is a possibility they won't get NAV for them. We'll just have to wait and see on this. There's nothing in this structure that rewards the manager based on how much they achieve from realising the portfolio. That might come when we get the proposal, detailed proposal. I'd probably quite like to see that, to be honest. Scottish Mortgage. I've been moaning for ages that this discount's too wide. It's still about £11 billion fund. I actually wrote about it last May, saying maybe you should think about buying this now because it just seems to be like too wide. The discount number is 22%. The share price didn't actually move then until November, when interest rates had started sort of appearing, and it's gone up a bit, but the discount is still too wide for a fund like this, which was issuing an awful lot of stock at asset value, and I think they should have been much more aggressive about sorting the discount up before now. So they're saying, big announcement today, £1 billion buyback, which sounds amazing, given the size of the rest of the sector. But actually, this is still less than 10% of the issued share capital, and it doesn't need to make this splash. It could just be buying the stock back anyway. It's got permission to buy back 15% like normal. It's really interesting how much buybacks have tailed off over the past year, and that's part of the reason why the discount's been so wide. And then doing that, so we have to sort of second guess what they've been up to. One thing they mentioned is gearing. So they've got a lot of long-term fixed rate debt, and actually the good thing about that is that a lot of that is really quite cheap. So it's long-term fixed rate debt at low interest rates, and that actually enhances the NAV. So because they're obviously all the NAVs that we use and everywhere else in the industry uses are fair value of debt NAVs, and that gives you a credit for borrowing money cheap when interest rates are now higher. So if they have to get rid of some of that gearing to stop the gearing ratio going up, that you have to sort of destroy some of that value. But nevertheless, it does kind of work out the maths. I think there's definitely no argument against it. And any lenders can be quite happy to let you pay back early if they've been undercharging you on interest. So it should be quite easy to fix that. The other more impactful thing is probably the percentage in unlisted. So we've had this swinging around of the NAV, and they have breached the 30% limit, which is a self-imposed rule. It's not something that's imposed externally on them, but they have breached it a couple of times. Now, at the moment, this is the figure at the end of February, so it's down to 26.2, and they're saying they could buy back £1 billion worth, and they're going up to 20.3, so that will be great. But obviously, the market can still swing around from here, and that does sort of indicate to me that even despite this big announcement, if the market fell tomorrow, the discount probably widen again, and they'd probably be hampered from doing buybacks. So they really do need to get this percentage down through IPOs and trade sales and stuff like that to be able to get this thing sorted. Now I'm going to hand over to Richard.
Great, thanks, James. Yeah. So regional REIT. So we've actually seen this chart. The discount was really widened massively. It's now almost 80%, which is unbelievable, really, quite unsustainable. And its dividend yield over 30%, and that was a dividend that was cut fairly recently as well. So the share price, the pressure on the share prices has obviously been these are focused on offices, which is quite a challenged market. And obviously high interest rates, things like that, the value of their portfolios has really taken a hit. So press story earlier this week that they were considering a rights issue of around 75 million, which would be at a material discount to the current share price, which at the time was about 20p. It's fallen a bit since then to about 14p, 15p. So my guess is it'll be around 10p if this did go through. And that's because they've got this sort of looming £50 million retail bond that matures in August. So what's that? Less than 6 months away. They also said that they've also quite advanced in prepping this or another option of debt or maybe a bit of both to service this bond. I mean, the question that I suppose is on everyone's lips is how has it got to this sort of less than 6 months to go until maturity, and it's still not been dealt with. I believe they had a disposal program in the offing, and I don't think that's gone as well as they thought it was. Obviously, the market being what it is, they haven't been able to sell the assets that they wanted to sell at the prices that they wanted to achieve for them. But also another big question is, with this impending bond maturity, why have they still been paying this dividend, which only recently was cut, and they were paying £34 million a year. It's now been cut, and it will be around sort of 24, 25 million pounds a year. But anyway, here we are, and so we're shareholders are in between a sort of rock and a hard place, I think, really. So if this was to go through at 75 million, obviously this is all was in the press article. It's not been confirmed at that level or anything, but if it was, LTV would drop to around 45%, which is still quite high, especially considering that values keep declining. So that will sort of push it back up again in 3 months' time or 6 months' time, whenever the next valuation is. The debt is fairly cheap at today's standards, 3.5% fixed, about 3 years left on it, the rest of the debt. So it could see being a better position if this were to go through. Another question is it time to just chuck in the towel, really? 8% discount, the market is challenged, there's 20% vacancy in the portfolio. It's gonna, even without that, gonna take a lot of capex to bring it up to standard, to let this space and get earnings back up and things like that. are you just chucking good money bad, really? So we also got to be thinking, obviously, 10p a share, 75 million, that's 750 million new shares. That would be 60% of the enlarged company. Would there need to be an underwriter? If they did, is it ARA, the Singaporean company that bought the investment manager about a year or 2 years ago? Are they basically going to get the company on the cheap and take sort of ownership of it, really? So I don't know, lots of ifs and buts there. We'll have to see what they come out with. They said they'll make an announcement in due course when they've settled on an avenue to go down. But yeah, a lot of questions there. Feel sorry for shareholders, really, who are now holding that at sort of 14p when just before COVID, I think it was at 120p or something. So it's a lot of value lost there.
Yeah, definitely. I thought about buying some and didn't, thank God, but there we go. Good. Thank you very much, Richard. That's enough from us.